Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, great to talk with you. How you doing?
I'm doing great. Yourself?
Oh, I'm doing good. Interesting couple weeks since we last spoke. Stock market made a new low at the end of May and then bounced a little bit, but that bounce seems to be stalling out this week as we speak. And this morning, a crypto hedge fund apparently is liquidating as the crypto market also has taken a tumble.
Yeah, a lot of people who thought, if cryptos start going down, I'll just take my money out of the account. But the firms that run it have frozen accounts because people didn't read the fine print in their contract that could happen.
Yeah, I mean, they were thinking that, this is a crypto exchange is like a stock brokerage account or a bank account, which do all have insurance. At least in the United States, bank accounts are insured by FDIC insurance. I think it's $250,000. Stock brokerage accounts are insured up to $500,000 for the securities in the account, but crypto exchanges are not. And on one hand, it shouldn't be that shocking if people have been following the crypto market in past years. There were stories of exchanges overseas that were hacked, money stolen. Sometimes the exchanges completely shut down after such an event, and nothing ever happened to get people's money back. But I think a lot of people got involved in crypto as they were new in the markets over the past couple of years. There's just a surge of new traders after the 2020 market plunge. And probably a lot of these people just, totally had no clue that something like this could happen to them, but it is happening and probably going to likely keep happening because I don't think we've seen the bottom in crypto. Bitcoin fell at around 17,000 the other week. It bounced briefly back up to 20, but I wouldn't be shocked if in July it's making a new low below 17,000. It looks like it can fall below 20 at any moment now, and every time it drops, it's just like something else happens with the crypto fund or someone in leverage. It's just a tough thing. That's what happens in a bear market when things drop. People that are investors, no matter how big, that are over leveraged, they blow up.
I know it wasn't that long ago all these crypto promoters were saying it was better than gold and more secure. Well,
they're obviously wrong. And the thing about gold, gold is less volatile than the stock market. And so, for example, in March 2020, when the S&P 500 fell over 33%, gold didn't even fall 15%. And then gold came back faster than the stock market did. And I think that characteristic of gold is one of the things that's causing institutional money and large investors to move more of their money into it this year. Now, we did see gold have a surge around the period of that Ukraine war, and it's come back down from that high. But it's still up year to date as we're speaking, with the stock market averages down, Bitcoin down much more, obviously. But the bond market is down too. And the bond market is traditionally acted as a safe haven for investors in the financial markets. Since 1980, every time there's a bear market in the stock market, bond funds would go up because bond funds are tied to interest rates. When interest rates go down, bond funds go up in value. But the opposite happens too. And this year, we're seeing something not seen since the 1970s, in which the stock market has been going down. It's in a bear market too. And bond funds have been going down too with it. So this has thrown out the validity of the 60-40 portfolio strategy. Like put 60% of your money in stock, put 40% of your money in bonds, which had been a great strategy since about 1980. Didn't work in the 70s. It's not working now. It's not likely to be very good either for the rest of this decade, because I think we're in a real inflationary decade. Yeah, we'll get pauses in the rate of inflation, and I think we may be finally headed for such a thing. But watch out, because it'll come back, and a pause is not a meaningful decline either. But the key is people need an alternative as a safe haven, and I think that's what gold is providing for people and will continue to do so.
Mike, I've heard the key to wealth isn't making money in good times, it's keeping your money in bad. Is that your strategy?
Yeah, I think it is. Yeah, it really is. I believe, the thing about bear markets, and we're in one, we saw one in the stock market in 2007 and 8, one in 2000 to 2002, at least that's been since my trading career. But there have been bear markets in commodities that was 8 years long and ended in 2020 finally. Gold had one that ended in 2016. It was about a 4 or 5 year bear market there. And one of the keys is to be in a position where you're able to buy when the bear market is over. That doesn't mean you have to be 100% in cash, but you have to typically have some sort of cash reserves in order to buy. And you got to be patient and let things play out to get to that point. So that's something I started to do last year. Is I started to liquidate, not everything, but I raised cash reserves about a year ago. And then coming into this year, actually began to hedge, which is a little more complicated. It's not necessary for people to actually do that. But the key is to have some sort of money management strategy. That 60-40 portfolio, one of the keys behind it is to rebalance, meaning that if the stock market went down and the value of your bond funds went up, at some point you would sell some of the bond funds to buy stock. And I think that methodology makes it so you don't have to perfectly time the market. In fact, if you do it on a regular basis, meaning a set period of time, like once every 12 months or once every 90 days, you don't have to time the markets at all using that rebalancing strategy. And it's a philosophy I think can work now, even if you're not going to be 60% stocks, 40% bonds. You can be 10% in cash, and there's your reserves that you can be using, to buy and average down at certain periods. I think it's wise to be diversified by owning gold ETF, metals ETF, gold ETF, and even some mining stock. Even though they are correcting at the moment or appear to be pulling back at the moment, not as much as the stock market, but they are since they've had that last peak in March. But all that said, I think the thing people should do is look through their portfolio and get out of things that are actually dangerous to continue to hold on to when you're in a bear market in the stock market, which we're in with the S&P 500 trading below its 200-day moving average, and that moving average now acting as resistance. That's how I define a bear market. But in bull markets, you get pullback that typically will last a couple weeks, no longer than 2 months. And if you look since 2009, when the stock market bottomed, then the only time there was a pullback that lasted, there wasn't one at all actually that lasted as long as this one. So people should take that as a sign that this is not just a simple correction in the stock market. Now, I think most people are actually realizing that, but they're not doing anything about it. And I think a simple thing, perhaps the best thing that people can do now, is look through their portfolios, look at the stocks they own, look at the funds, whether they're mutual funds or exchange traded funds, and see how those funds are doing compared with the S&P 500. And what you want to look for is look for things that are performing worse than the S&P 500. So when the stock market pulls back, they fall off. And then when the stock market has a bounce or rally, like the S&P 500, it just did, from May to looks like a couple days ago, and or June, end of May to a couple days ago, then had one, it bounced, in May and then peaked in early June and dumped and then made a low like 2 weeks ago and is peaking out again. But on those declines, the things that lag the S&P 500, they tend to fall much more than the average. And then when the average has the bounce, it doesn't make back the losses. So they're like millstones in the account. In stocks that trade like that, if you don't know the fundamentals, you can easily be owning a stock that's in a company that's going to end up going bankrupt or go down, 99%. If you don't really understand what the balance sheet is, you just bought off a tip or because you saw someone talk about it. And there's going to be a lot of companies that do go bankrupt, because the rates going up is going to drive up the cost of their finance. A stock like, Carnava, is a company that is likely to go bankrupt one day. It just has so much debt and, there's all kinds of individual stocks like that. But look for the relative strength, which is a simple ratio, the stock divided by the S&P 500. It's an indicator. If it's going down, it's lagging, and it's bad to continue to hold it. And you use a bounce like now to get out, and there's your cash reserve. So you can do that, and be selling these bad situations that are going to most likely continue to hurt your portfolio and use the proceeds. There's your cash reserve. Now you got things that are outperforming the market, which is what gold is doing. Gold's up while the stock market's down. Those are things you want to keep holding on to. Not sell to get out, not get out of that to get cash reserves, sell the losing situations, the laggards. And the thing about crypto is it's lagging. When the market falls, Bitcoin and these other crypto coins fall worse than the stock market. And then when the market has the bounce, they don't take back the losses. And I think this bear market is likely to go on the rest of the year. It could go on, into the first quarter next year. It may be even worse than that. But it doesn't matter because the longer it goes on, the worse these type of lagging stocks and funds and crypto will hurt people. And I think they should just get out now and just name one fund that's a horrible laggard that Kathy Wood ARC ETF is just a complete disaster, and a lot of people still own it, and it's just dragging people down. And I don't want people to get hurt like that.
We'll have more with Mike Swanson right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, we always like to check out the Robin Hooders and your situation or your view on them. Are they still investing in things that are going nowhere except down?
For the most part, I'm going to load up really quickly. I think something interesting is starting to happen, but I'm looking at the 100 most owned list, and there's very little change on it. Tesla's the stock at the top, Ford, AMC, Sundial's on it, Facebook, Netflix, which Facebook and Netflix are two stocks that have crashed twice, both of them twice already this year. Lucid's on the list. Robinhood itself is now $8.54. It's on the list. But all these stocks, I mean, if I took the time to chart them out, look at the 200-day moving averages, 90% I'd say are below the 200-day moving average. One that I'm looking at Exxon's on the list. That's one that's still, above the 200-day moving average. But the rest of them are below it. Now, I think something interesting is starting to happen in, Robinhood, when they released their last earnings report, said that roughly 10% of their customers stopped actively trading. They essentially blew themselves up. And I look at something on Fidelity that they update every single day, live actually. People can find it. They go to Google, type Fidelity orders by customers, and they show you live the top 30 stocks and ETFs that people are buying, trading, and they show you the ratio of buy to sell orders. Now, so for instance, at the moment today, past 1 o'clock, Tesla has 5,700 buy orders from Fidelity customers, 3,000 sell orders. Well, on one hand, they're doing a lot more buying than selling in what I think is a bear market. And I believe when the bottom comes, that'll be reversed, that there will be, a panic phase that brings a bottom and there'll be mass selling, but people are still buying. But I think what's going on is that, on the Robinhood top 100 list, there's less activity of the stocks moving up and down the list or new stocks ever appearing on the list. And this Fidelity data of the number of buy and sell orders, I started looking at it around January. And if you total all the number of orders up, it's starting to shrink too. What I think this means is that when it comes to individual traders, there's fewer of them trading now than it was at the beginning of the year. And as this bear market goes on, the number is going to continue to decline. However, those that remain are still doing what they were doing last year, buying the same fad stock, trying to hold on to them. And in the case of Robinhood, still trading the silly coins, because you log in there and they try to encourage you to buy crypto coins because they got that on the app in a real prominent position. So, in other words, people are not really adapting to the market that are driving all the daily trading activity. The problem is these people cannot control the market. The dream that we were told could be a reality when the AMC jumped up to the moon and, dominated the daily news cycle was that the individual investor could rule, could destroy hedge funds, could push the markets higher and higher and take over. Well, they don't have the financial ability to do that, and they're losing money. So their influence in the market is diminishing every single week. you're no longer really seeing stories of, a herd making a cryptocurrency go up 100% to new high. I don't know if that's even happened once this year. You're not hearing any more stocks about like AMC and GameStop, and no more stories like that. The day of, all that was just a fantasy that people were talking about, and the power of these individual traders is just shrinking and shrinking, and what's happening is, who's taking their place. We're in a bear market. And when you're in a bear market, people who are insiders of companies, people who invest in stocks because they think, the economy, they want earnings growth. They look at what's going on in the real world, not on an app. They're sellers. They're selling on rally. And that's what drives the bear market down. And all this said, how do you make money in it? Well, like I said, cash reserves is key, but also focusing only on sectors and asset classes is a missing gold that are not, in these vicious bear markets and are acting better than the stock market. And, with the stock market, there's few sectors doing that. And they're not the ones that these people in Robinhood are holding. So it's making a very difficult game at the moment for people.
Mike, thank you so much for chatting with us.
Thank you. Great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@HowStreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.